Hello, I'm Mariam Lawal, Sustainability Analyst at the Chartered Banker Institute. Each month, we aim to deliver a brief overview of the major climate-related financial issues and developments from around the world. Here is a rundown of what has taken place in climate-related financial regulation between the period December 2022 to March 2023 and what might be coming up soon. I hope you find this briefing useful, but if you have suggestions for improvement, do let us know. Contact details will show on the final slide. Finally, please feel free to share this update more widely via social media. Thank you. The UK World Bank definitely expects to issue Rhino bond replicas in 2023. The World Bank has said that it expects to come to market in 2023 with a similar bond structure to its Nouvelle Rhino bond linked to two South African conservation projects. The group will also consider similar bond structures linked to other animal conservation projects as well as carbon credits. However, unlike the Rhino-type bond structures wherein the coupon is not repaid but used to fund a project like the Rhino one, the carbon-linked bonds are expected to generate carbon credits used to fund the repayment of the coupon and the principal payment of the bond. In addition, the issuance of blue bonds are reportedly picking up rapidly in corporate, sovereign, and financial institutions. There are implications for commercial banks to glean from these projects as key learning resources to aid the development of their sustainability-linked bond initiatives. In the EU, stricter fossil fuel rules for EU bank capital voted down in blow to green groups. Legislative plans that could make it significantly more expensive for banks to finance fossil fuel projects failed at the first hurdle in a preliminary vote at the European Parliament. The Committee on Economic and Monetary Affairs (ECON) excluded a proposal that would require banks to put aside €1 of their own funds for every euro that finances new fossil fuel exploration or production to absorb any potential losses. This is in contrast to the cause jeered by green finance groups that current capital rules do not reflect the risks of financing fossil fuels because banks are mostly relying on publicly funded bailouts to cover losses. EU co-legislators have moved to finalize the implementation of the international Basel III banking reforms. On international updates, in the US, the Federal Reserve Board has provided additional details on climate scenario analysis exercise. The board will be working with 6 US banks on the pilot climate scenario analysis to gather qualitative and quantitative information over the course of the pilot covering issues such as governance and risk management practices, measurement methodologies, risk metrics, and data challenges to help peer groups gain insights from the pilot at an aggregate level. In emerging markets, Brazil, China, and Southeast Asia could account for more than half of the projected $22 billion nature-based solution revenues in 2030. This is according to a report from the Inevitable Policy Response IPR's first integrated nature and climate scenario. The FPS plus Nature incorporates interrelated climate and nature trends to IPR's flagship 1.8 degrees Celsius forecast policy scenario to create a realistic assessment that can help investors respond to the climate and nature emergency. On our February to March updates, in the UK climate scrutiny body calls for mandatory adaptation plans for financial institutions. The UK Climate Change Committee (CCC) wants UK companies and financial institutions, particularly government-owned companies and public financial institutions, to lead the way in measuring and managing the physical risks and how these impact wider adaptation outcomes to enable the country prepare for the physical impacts of climate change. In a report published by the CCC in January 2023, adaptation has been shown to receive relatively lower investment and financing. The CCC has proposed the inclusion of adaptation plans for companies and FIs, building on the net zero plans that will be a publication requirement for listed firms and FIs, and further urges financial regulators and government to ensure to stir up companies and FIs in the direction of mandatory regulation reporting and enhanced supervision, whilst encouraging them to put in more effort. On data dilemmas, the main issues facing banks is the reliance on third parties for climate risk modeling, as well as the inaccuracy of the data. Furthermore, the report noted that the potential negative implications of banks adjusting their lending practices to become more climate resilient is that it may impact companies and individuals looking to access finance. ESG Roundup. Barclays commits to halting oil sands financing. Barclays has updated its energy policy to stop financing oil sands exploration and production companies, as well as the construction of new oil sands exploration and pipelines. The bank has also expanded its commitment to cover the phasing out of coal-fired power generation to include OECD regions beyond the UK and EU countries. Sustainability-linked bond SLB issuers likely to miss majority of 2022 and 2023 targets. According to an analysis from Barclays, majority of the SLBs with target measurement dates in 2022 and 2023 are likely to miss their goals. Out of the 5 index-eligible SLBs with observation dates in 2022, there are uncertainties if 3 would meet their targets. And out of the 15 with observation dates in 2023, only 3 have met their targets. This is largely due to Enel, an energy company which accounts for 1 of 3 bonds off track in 2022, and 9 of the 12 bonds off track in 2023. However, other outstanding issuers comprise of chemical, brake manufacturer, and water management firms. Increased dependence on coal usage, the war in Ukraine, and limited government policy for the nascent asset class have been cited as reasons for the missed targets. Fossil fuel financiers need to take responsibility, says Academica Pension CIO. Pension fund Academica joins investor-focused UK campaign group Share Action in its letter to European financial heavyweights on halting fossil fuel financing, even if that means taking a hit to its bottom lines. Recent years have seen the increased scrutiny of banks' fossil fuel financing by investors. While several banks such as Barclays, one of the first banks to set a net zero target for 2050, have disclosed their sustainability commitment and plans, it is still important that they ramp up their efforts to halt fossil fuel financing. Bank of England BOE warns against extending bank capital time horizon, to account for climate risks. BOE frowns at extending horizons for banks to assess climate risks and set capital buffer levels. Typically, bank capital requirements are often calibrated over 1 year to ensure financial institutions are resilient to near-term unexpected losses. Previously, the bank had purported that a 1-year time horizon is a poor fit for climate-related risks, given that they typically crystallize over relatively longer time horizons. However, Current evidence shows that the existing time horizon will still be sufficient for banks to recapitalize in the event of a climate-related loss. Introducing such change to the regulatory capital framework could create unintended consequences. Rather, there might be positive implications of extending the regulatory time horizon to capture risks in the capital framework of banks and insurers to increase protective measures. Ongoing work would focus on improving the ability of internal bank systems to identify and manage risks within the one-year time horizon. Nature Alpha collaborates with MSCI to launch solutions for investors. Implications for commercial banks. Nature Alpha, an organization that provides science-based machine learning-powered biodiversity analytics and nature accounting tools via API or platform to global financial institutions, collaborates with MSCI to launch solutions for investors seeking to track biodiversity and nature risks, footprints, and dependencies on their investments. The index provider will distribute the biodiversity analytics company's data and analytical tools to the global investment community. Increased availability of portfolio-level data to the investment community would have positive implications for banks to develop sustainable products. In the EU, European Central Bank (ECB) deepens green tilt in corporate bond purchase program. The ECB, Europe's largest purchaser of corporate bonds, is winding down its corporate holdings under the asset purchase program as part of its quantitative tightening measures. It has deepened the green shading of its corporate bond investment program, announcing an end to all primary market purchases of all but the greenest issuances. In July, the bank announced plans to introduce a climate tilt to the roughly 30 billion euros of annual reinvestment from its corporate sector purchase program CSPP, a subset of its asset purchase program, which would be based on issuers' backward-looking emissions, among others. We stand with Ukraine. EBRD, European Bank for Reconstruction and Development, vows to support green reconstruction. Ukraine's post-war reconstruction has several green elements with implications for commercial banks. Fighting back against the Russian invasion, Ukraine leaders do not yet know when the war will end, but are hoping to restore their economy better and greener with the goal of moving towards climate neutrality. The country has huge potentials for creating green energy power plants, producing green hydrogen, transporting low-carbon gases, and decarbonizing the extraction and processing of Ukraine's raw materials, which require significant investments. The EBRD has weighed in heavily in their support towards rebuilding Ukraine's economy through donors and grants, with commitments to support a green transition towards its long-term growth and prosperity. Ukraine's financial system will channel green finance to businesses spanning the development of risk mitigation products, facilities for agribusinesses, sustainable farming, etc., and these would typically be implemented through commercial banks. Such financing facilities would benefit from donor grants and guarantees. Investment incentives will enable banks to focus lending on projects that combine post-war reconstruction with energy efficiency and decarbonization efforts. International Space, People and Appointments, Office of the Comptroller of the Currency hiring Climate Risk Director. The United States is ramping up its efforts towards climate risk with significant progress towards expanding knowledge and capacity. The U.S. Office of the Comptroller of the Currency is hiring a Director of Climate Risk. The candidate will be responsible for identifying, monitoring, and reporting on climate risk for supervised institutions, developing new or revised supervisory policy, guidance, and examination procedures. On our global updates, World Bank adds carbon credits component to Rhino bond revamp. Like its Rhino bond structure, the World Bank has returned with a $50 million bond deal linked to the manufacture of water purification devices in Vietnam. Coupon payments from the deal will be used to fund projects manufacturing water purifiers in Vietnam for schools and other institutions, which would have a dual impact on improving access to clean water for about 2 million children and displacing biomass burning. Carbon credits generated from the project will be issued on the Vera registry. Proceeds from the deal will be used in World Bank projects and any other sustainable development bond issued by the bank. Financial institutions woefully behind on deforestation risk, says Global Canopy. Global Canopy's annual Forest 500 report says financial institutions are still not taking sufficient action to address deforestation risk. Global Canopy looked at financial institutions funding corporates such as Amazon, IKEA, Unilever, which are deemed to have highest exposures to forest risk commodities. Most of the financial institutions have no commodity-specific policies on deforestation for any of the forest risk commodities that they are exposed to. The report further highlighted that a total of 92 financial institutions without commodity-specific policy on deforestation provided finance to the tune of $3.6 trillion to corporates with the greatest exposures to deforestation risk in the forms of loans, bond holdings, and underwritings. Emerging lenders in the space are showing that robust public policies and rapid progress are possible towards managing deforestation risks. International Sustainability Standards Board (ISSB) approves first sustainability standards including reference to Global Reporting Initiative (GRI) and European Sustainability Reporting Standards (ESRS). ISSB, which was launched by IFRS Foundation in 2021, has signed off on its first two disclosure standards for companies, including one that references the GRI and EU Sustainability Reporting Standards. Exposure drafts IFRS S1, which is the general requirements for disclosure of sustainability-related financial information, and IFRS S2, which is climate-related disclosures, were approved by ISSB and will be subject to routine checks before the approval becomes formal tentatively by January 2024. World Water Day, Blue Bond Guidance launch expected in June. A consortium of International Capital Market Association, ICMA, ICMA, UN Global Compact, the United Nations Environment Programme Finance Initiative (UNEP-FI), International Finance Corporation (IFC), and the Asian Development Bank aims to launch Blue Bond Guidance by World Ocean Day, 8th of June, to help financial institutions to have a better idea of what they will use blue bonds for. Public and private organizations have turned to blue bonds to raise funds in the market years, but the market remains a tiny subset of green bonds. Between 2018 and 2022, 26 blue bond transactions took place, but they represent only 0.5% of the sustainable debt market. The main hindrances in the blue bond market has been a lack of standardized definitions, metrics, and expertise by issuers. However, there's been a notable interest by the government and an environmental organization like the Nature Conservancy (TNC) in utilizing debt conversion as a tool to establish and fund long-term ocean conservation strategy. There are hopes for more announcements this year with respect to debt conversions and blue bonds. Final TNFD draft framework sets out disclosure metrics. TNFD has published the fourth and final version of its TNFD framework before releasing final recommendations in September. The TNFD has outlined measures that would enable comparability across and within sectors, as well as provide flexibility for report preparers considering nature-related issues across sectors and business models. The metrics are divided into 9 relating to nature impact and dependencies, and 5 are focused on risks and opportunities. Notably, a key proposed disclosed metric for the opportunities is the value of capital for nature-related opportunities.